In this video, we will talk about government spending and the national debt. How does government spending impact the economy? And what can be done to address the national debt in the face of a recession? In summary, there is no obvious link between national public sector, debt, and levels of economic growth. Both UK and US finished the Second World War with high levels of national debt. But this did not prevent rapid economic growth in the 1950s and 1960s. High growth helped to reduce the national debt as a percent of GDP. However, some free market economists argue that above certain levels, very high national debt can curtail economic growth because there is crowding out of the more efficient private sector. A controversial paper, Growth in a Time of Debt, 2010 by Karin Reinhardt and Kenneth Rogoff, argued that GDP growth slows to a snail's pace once government debt levels exceed 90% of GDP. Though these findings have been challenged by other reports, Keynesians argue that in recessions, with falling private sector spending, government borrowing can provide an effective fiscal stimulus to increase growth rates in the short and medium term. Another complication is that low growth in recession causes rising national debt, fall in cyclical tax returns. High growth helps to reduce it, improve tax returns, less spending on benefits. High debt has not been a barrier to economic growth in the past. The period of the 1950s, when national debt was over 200% of GDP, was not a barrier to the post-war economic boom. Crowding out argument. If there is persistent government borrowing, then some economists argue crowding out is likely to occur. Crowding out occurs when higher government borrowing leads to lower private sector investment and spending. The argument is that the government borrow by selling bonds to the private sector. If the private sector buys government bonds, then they have less to spend in the private sector. Furthermore, government spending tends to be more inefficient than the private sector. Therefore, government debt can affect growth rates, especially if the economy is close to full capacity. Crowding out due to higher interest rates. It is argued persistently high levels of government borrowing may lead to higher interest rates. This is because with high levels of debt, higher interest rates will be required to attract people to buy government debt. If interest rates do rise because of high government debt, this will make borrowing more expensive and reduce debt levels. This occurred in the Eurozone between 2010 to 12, with liquidity shortages. Higher debt caused bond yields to rise. However, after 2012, the ECB were more willing to provide liquidity and bond yields fell. However, higher debt doesn't necessarily cause higher bond yields. Bond yields are influenced by many factors other than the level of debt. For example, between 2009 and 2016, UK national debt increased considerably, yet bond yields fell. Bond yields fell because markets were keen to buy government bonds. Bond yields were also low because it was a period of weak economic growth. High debt and future higher taxes and lower spending. The scale of UK government borrowing means that to reduce the debt burden, the government will have to increase taxes and slash or cut spending over the next 3 to 4 years. These higher taxes and lower spending will have the effect of reducing UK economic growth and could even damage any economic recovery. However, if fiscal policy is tight and reduces inflationary pressure in the economy, it can enable interest rates to stay lower, and this expansionary monetary policy may offset the deflationary fiscal policy. Keynesian view on debt. Government borrowing can act as an economic stimulus. The government is spending by borrowing from the private sector, and this can lead to injection into the circular flow. In a recession, crowding out is unlikely to occur because there are unemployed resources. Keynes argued in a recession, government borrowing can help increase the rate of economic growth because the government makes use of unused savings. Expansionary fiscal policy. Why is government borrowing? If the government is borrowing to invest in public services like transport and education, it is possible the government will increase production capacity and enable a higher rate of economic growth. However, if the government borrowing is to finance transfer payments, pensions, and healthcare to an aging population, then there will be no boost to productive capacity from government borrowing, and the borrowing will be less sustainable. Another issue is whether high levels of debt will provide a constraint to future growth, because of the forecast tax rises, which will be necessary to reduce the debt burden to more manageable levels in the future. In the post-war period, growth helped reduce debt ratios. Impact of increasing government spending. Increased government spending is likely to cause a rise in aggregate demand, AD. This can lead to higher growth in the short term. It can also potentially lead to inflation. Higher government spending will also have an impact on the supply side of the economy, depending on which area of government spending is increased. If spending is focused on improving infrastructure, this could lead to increased productivity and growth in the long-run aggregate supply. If spending is focused on welfare benefits or pensions, it may reduce inequality, but it could crowd out more productive private sector investment. Welfare benefits. This spending will help to reduce levels of inequality. For example, benefits to the unemployed enable them to maintain a minimum income and avoid absolute poverty. There is a potential higher welfare benefit that could reduce incentives to work, but on the other hand, welfare benefits can also help the labor market to function more efficiently. Pension spending. An aging population requires higher government spending, pensions, and healthcare spending. But pension spending has no impact on boosting productivity. Education and training. If successfully targeted at improving skills in education, government spending can increase labor productivity and enable higher long-term economic growth. Infrastructure investment. Higher spending on roads and railways can help remove supply bottlenecks and enable greater efficiency. This can also boost long-term economic growth. Higher debt interest payments. If the government has higher debt and higher bond yields, then it can cause increased costs of borrowing. This spending will go to investors and have no benefit to the economy. Evaluation of higher government spending. How is spending financed? It depends on how government spending is financed. If government spending is financed by higher taxes, then tax rises may counterbalance the higher spending, and there will be no increase in aggregate demand, AD. Crowding out. If the economy is close to full capacity, higher government spending can lead to crowding out. This is when the government spends more, but it has the effect of reducing private sector spending. For example, if the government borrows from the private sector has lower savings for private investment. Make sure to watch the full video. Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.